We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is legendary Rick Ruble. He's an investor, speculator, and the founder and CEO of Ruble Investment Media. Thanks for joining me today, Rick.
Tom, it's always a pleasure. It's been too long.
Absolutely. I couldn't agree more here. As it is, going through and doing some research for today, it struck me that the last time we actually spoke was in January. So we've got a lot to catch up on here, and maybe we can start by kind of getting some of your thoughts around the conflict. Obviously, we've spoken about it quite a bit in all the news, but it's always interesting to get your wise perspective on all of these things. So maybe we can start by considering, let's say, some of the differences between pegging a currency to a basket of commodities versus backing that currency to a basket of commodities.
Well, that's really interesting. I guess you're talking about the proposal by the Russians that they would make the ruble hard in some way, shape, or form. Understand that a peg as opposed to a back is a very different circumstance. Were they to warehouse in a third-party jurisdiction the assets necessary to back a currency, that would be a very different thing. In other words, if the currency was exchangeable for a basket of commodities or even for gold, literally exchangeable, that's one thing. Pegging it is just a different frame of promise. Right now, it's pegged to the full faith and credit of Russia, which is to say, not much. And if you promise that you're going to link it, backed by nothing, with oil and wheat and nickel and copper, you have a circumstance where you merely have a different promise. I think it's an interesting public relations stunt. I certainly understand the desire of the Russians, the Chinese, the Indians, the Iranians to affect a global medium of exchange that isn't subject to the extraterritorial reach of the United States. I 100% get that. I understand the challenge that they have too, in the sense that while none of those countries trust us, they don't trust each other either. They trust each other less. And I think what you're going to see, yes, I think the Russians will make some noise about a pegged currency, but I don't think that there's going to be a market for the currency. I don't think that they're going to hoodwink the Indians into believing that they could exchange rubles for physical commodities, because it's not in the interest of the Kremlin to have the currency backed by anything. If the currency has to be backed, you lose the privilege of seigniorage. What governments around the world have the ability to do when it's backed by the full faith and credit of their governments is counterfeit. They can engage in quantitative easing. They can print. And the idea that a government would willingly lose the ability to print, lose the ability to counterfeit, lose the power of the press when the currency of politics is power makes no sense to me.
In maybe power and promise and the ability to print is inherent in those promises and making that appealing to their voter base, right?
Certainly. The nature of politics, this isn't true, but I laugh that you understand the process of politics by understanding the root words. Poly from the Greek for many, and tick from the English colloquial for small blood-sucking insect. What that means is that if you're a politician, what you're really doing is, as Mencken would say, presiding over an advanced auction of stolen property. You are allocating resources amongst competing elites. The quid pro quo is you reward them and they keep you in power. And the losing the ability of seigniorage, which is to say losing the ability of counterfeiting, would be an important blow to politicians' abilities to deliver. And the consequence of that is that I don't think any politician, including any American politician, would ever give that up.
Mm-hmm. So, Rick, when you said the if they had a backed currency, that would have to be in a let's say neutral third party jurisdiction, and yet we saw at the beginning of the conflict the U.S. seized something like $300 million of Russia's foreign held assets. Does that present a real challenge to be able to consider, quote unquote, backing a currency to be able to really trust that third party?
Well, for a country, it certainly does. For me, it doesn't. I've come myself to measure my future obligations, my future income, and my assets in gold. I actually think in grams. I don't think in dollars anymore. So in a sense, I've backed my own currency because I look at my occupancy expense and living expenses in gold. And I think that individuals need to pay attention to the fact that they should be cautious about holding themselves too hostage to any one counterfeited currency. With regards to a government, the U.S. has been able, through the SWIFT banking system, among other mechanisms, and of course, through the petrodollar arrangement, to insert the U.S. dollar as the world's reserve currency. The United States, for political reasons, chose to weaponize that franchise, both in terms of weaponizing the SWIFT banking system and also weaponizing the U.S. dollar. That weakens the franchise of the U.S. dollar. It weakens what Charles de Gaulle called the exorbitant privilege of exporting your inflation to the rest of the world. But I guess the short-term political gain from the point of view of American politicians was more important than the value of the franchise. In times 100 years ago or 120 years ago, the policy of Swiss neutrality meant that very often countries' foreign exchange reserves, including their gold, was kept rather than in their vaults or in British vaults or in American vaults, in Swiss vaults. The idea being that the Swiss were neutral arbiters and could, irrespective of political winds, move gold from the Russian vault to the American vault or from the American vault to the Indian vault. It would seem that the Swiss are decidedly less neutral. It would seem, too, that with the global financial system relying more on US dollar denominated securities than on gold, that the Treasury's ability to, in effect, cancel the US dollar holdings of foreign currencies has meant that the probability that there could be a neutral arbiter in US dollars is gone.
So, Rick, if we think about the case that these countries don't trust each other, as you said, how do we think about creating a medium of exchange, or what type of medium of exchange do you think that they need to create in order to create that trust and have something, or even if they want something to replace the US dollar as that reserve currency?
I believe that governments are inherently untrustworthy, pardon me. So from an individual's point of view, the fantasy that the big thinkers of the world, that the World Economic Forum, as an example, is going to come up with a medium of exchange that's simultaneously a store of value, which is to say a medium of exchange that individuals can trust, I think the probability of that is nil. Mm-hmm. The ability that they might have to come up with a new international financial mechanism that allows them to maintain power at the same time that they reassert some confidence, that might exist. I'm not smart enough to tell you how they might do that. Mm-hmm. It seems to me it's more of a promotional exercise than anything else. And my mindset is such that it's very difficult for them to promote me because I dislike them all. But I could understand how there could be a system of special drawing rights, as an example, against a basket of currencies, which is to say that they backstop a counterfeit instrument with a basket of other counterfeit instruments. I could see how that would work because I think most of the people in the world don't want to have to concern themselves with this whole concept. Most people in the world want Big Brother to protect them and shelter them. Most people in the world, I think, unfortunately, don't want to take responsibility for their own financial future. And think about this. Hell, I don't want to. I don't want to. The truth is that I don't personally see too many alternatives.
Well, and I think to me, it always comes back down to incentives. If for example, the World Economic Forum wants to, create some type of currency, as you're saying, it's going to suit them, and they're going to sell it to you as though it's better for you and easier. I don't know if you've seen this clip of they want to institute a way of tracking your own carbon credits so that you yourself can realize how much carbon you're emitting, right? But that seems like a fancy way of saying, this is selling something that is probably more nefarious, right?
You will own nothing and you will be happy. I don't think so. I don't think so. Maybe that's less appealing to people like us, right? If you look through periods in time where there's been a reckoning, people who were relatively independent thinkers and people who took control of their own future did better than other people. I seriously hope, for all concerned, myself included, that we don't face any more reckonings. The last 40 years have been the most peaceful in human history, the current conflict notwithstanding. And I hope the world gets nicer and nicer and nicer and nicer and nicer. And I hope that all of the safeguards that I've put in place for myself when I shed my mortal coil will have all been unnecessary complications in my life. I sincerely hope that. That would be a wonderful circumstance. But I also feel that since I'm intellectually and financially capable of, to some degree, safeguarding my future, irrespective of the depredations of the big thinkers, that I should do that.
Yeah, I think it would be an excellent situation if none of those safeguards had to come in place, and that's something that I try to tell people all the time and on the show as well, is that even if you go out of your way to put any of these safeguards in place, you're not going to be worse off at the end of the day for doing some of them.
Let's suppose you're a little worse off, actually. Let's suppose that it costs you 2 or 3% of your working time and 2 or 3% of your net worth. That's probably a reasonable insurance premium. When I look at the money that I've spent putting in place completely legal offshore structures, when I look at the gold I've owned rather than owning U.S. 10-year Treasury securities, when I look at the cost of everything that I've done defensively, the costs aren't unsubstantial, but they allow me to sleep nights and stay calm, and I value my sleep. I truly now believe that the essence of wealth is enhancing your sense of well-being. And personally, the safeguards I put in place for myself and my family, some of my clients, some of my friends, actually enhance my sense of well-being. And in that sense, they're well worth the time and treasure that I've spent affecting them.
Yeah, and it really comes back to the conversation that you and I had a little bit before we hit record here about that the risk versus reward equation that we all have to evaluate for our own lives. Correct.
You know, this is an interesting discussion and not one that I normally get to engage in. Normally, hosts like you are looking for some clickbait, how to make $1 trillion by Thursday.
There's not one easy answer. There's not one thing we're all missing about that.
I would regard education in the same light. I think that the best possible investment that you can make is in your own continuing education. Knowledge, yes, as you get senile, it can be lost, or if you get lazy, it can be lost, but it can't be stolen and it can't be taxed. The benefit of it can be taxed, but there's nothing in my life that's generated a higher return on capital or time employed than study and education. Sometimes the benefits are intangible, but I have to say that the intangible benefits that I've received from study have been immeasurable. I try to read for an hour and a half or 2 hours a day, and it's a wonderful use of time. That doesn't mean that everything I read benefits me immediately financially, but it benefits me in terms of developing attitudes which are useful in other aspects of my life. And it benefits me because I enjoy the hell out of learning.
Well, I think that's an excellent attitude to have. And Rick, what are some of the things that let's say that you've read over your life or that you're currently reading that you think hold great value and that have taught you some great lessons?
I have 4 books that every young investor should read. They are in order: Economics in One Lesson by Hazlitt. It tells you the way the world works as opposed to the way that the big thinkers in your university think it ought to work. It's a short book, a quick book. It's just a wonderful book. So start with that. Mm-hmm. The second one, if you're going to become an investor, is Graham's classic, The Intelligent Investor. The best investment book ever written relative to the effort required to read it. It's readable, it's quick, it's short. If you were interested in that book, the next book is Securities Analysis, maybe the best investment book ever written, but not easy to read. A wonderful cure for insomnia. Normally, when I'm done with it, I begin to reread it, just so that the discipline in place, the common sense in place, sticks in my mind. The final book that I think is necessary for an investor is Human Action by von Mises, talking about human volition and about how society is an amalgam of human volitions. It is the best book that I've ever written that I've ever read, to understand the interrelationship between incentives and will, and how the political process works. The most recent book that I read, I finished it yesterday, was Skin in the Game by Taleb. Mm-hmm. I'm a huge Taleb fan. Anti-Fragile was, from my point of view, one of the most amusing modern books I've ever read. So I would certainly recommend Anti-Fragile, and I would certainly recommend Skin in the Game. The other thing that I would encourage any young investor to do, and it's free, is go onto the Berkshire Hathaway website and read Warren Buffett's annual letter to shareholders. Mm-hmm. And when you read it, to the extent, depending on how old you are, try and remember the economic circumstance that it was written in. Buffett's letters to shareholders, I suspect, if they were studied, would end up being at least the best BA in finance ever given.
So, while we're kind of on this topic, Rick, how do you look at your role in educating young investors? Certainly, I've learned a lot from you. Everybody, whenever I tell somebody that I'm speaking to Rick Rule, everybody gets excited. So how do you see your role as really an educator in this space?
Both a joy and an obligation. I've spent 45 years learning how to do public speaking, mm-hmm. Because it's been an important part of my commercial career. The consequence of that, and the consequence of the fact that I'm always reading and always thinking, is I have, I think, and I've been told, a rather unique ability to articulate fairly complex topics in a fashion that's digestible. Mm-hmm. The fact that you're good at something often means it's pleasant to do it. I think there's 2 other things. By teaching, by mentoring, I honor the teachers and mentors who helped me when I was young. I had immeasurable help from about probably 30 mentors between the time I was sort of 18 and 30. Mm-hmm. And the idea that I wouldn't feel the obligation to pay it forward dishonors those mentors who gave me so much with the expectation of absolutely nothing mm-hmm. in return. The third thing is that if I want to see the world be a better place, to the extent that I can participate in causing that to occur, I ought to do it. It's a consumer good. It makes me feel better about myself. And it gives me energy. Not too long ago, I did an online forum on entrepreneurship sponsored by Students for Liberty for about 200 young African libertarian students. I came away from that almost high. I'm not saying high in a narcotic sense. I came away energized by the ability to help 200 people who were extraordinarily high quality people and who would, I'm absolutely certain, have a hand in making Africa a better place to work. And as a consequence of that, making the world a better place to live.
Mm-hmm. Well, I think that's it's
a consumer good for me.
Mm-hmm. I think that's a wonderful attitude and way to look at the world. And something I've had some discussions recently about is telling people, you have to pay attention to the whatever activities that you're doing that are intrinsically motivating or that give you energy like that. And do you think that you have in some ways used that to guide parts of your life?
I think increasingly that's what's happening. I was extremely competitive as a young person, and I just wanted to do my job better than my competition. I didn't think much about the social import of what I was doing. Mm-hmm. What has begun, without sounding too arrogant, I don't need to make any more money. I don't spend much, and I've been lucky. And I have enough passive income now that my wife and I can't spend a fraction of what we make. I like the process of investing. I like the process of building businesses. I mean, here I am at 69 years of age, starting a new bank. Obviously I'm sick. But I also really enjoy the process of sharing the knowledge that I've been lucky enough to assemble. I really enjoy it. And, for as long as I'm cognizant, I'm going to do that. I'm one of the youngest 69-year-olds I've ever met. And part of that is a consequence of hanging around with a lot of 19 and 20 and 21-year-olds. And so in terms of whatever I might give to them in terms of experience, I get back from them in terms of eagerness, enthusiasm, energy, things like that.
Well, Rick, I appreciate getting to delve into your a little bit of your philosophy on life here. And I appreciate getting to really, I guess, take a little bit of a dive into your mind and how you see things like that.
Well, if you're going to pick my brain, use a small fork, please. So,
Rick, when we think about economics, there's a saying that there's always a trade-off here. So, I think a perfect example of that right now is the economic sanctions that are being forced upon Russia. And I want to get your take on how far countries really go before they realize that the sanctions are actually hurting them. And when they can't get enough, let's say, energy or food, how do they get around that problem and maybe backtrack on some of those initial postures that they imposed?
Well, I think a lot of politics is pretending. I think some of these sanctions are pretend sanctions. We're Europe absolutely positively at war with Russia, sending all kinds of material support to Ukraine at the same time that Europe is buying Russian natural gas. And as the Russians would suggest, doing it in rubles. Mm-hmm. This is an interesting war, not a cold war, not a hot war, but rather a lukewarm war, a political war. The Russians are sending young people to fight and die, while at the same time selling the enemy raw materials. The Europeans seem to be willing to fight the Russians down to the last Ukrainian, while at the same time feeding the Russian war machine, because they know that while their voters are anti-Russian, their voters also want to consume Russian wheat and Russian natural gas. I think a war really is an illustration of what governments are about. I don't think that absent leaders, including leaders in the Ukraine and leaders in the West, certainly leaders in Russia, that we would be having a war now. I don't think that a spontaneous dispute between Russians and Ukrainians would have broken out, where people would have left their homes and their farms and their factories and gone to kill each other without governments exercising the self-interest of the elites in this circumstance. And so rather than having an existential war, of course, the war is existential for the people who are on the battlefield, but rather than having an existential conflict in Europe, what we have is the manifestation of realpolitik. Truly a tragedy, but you need to understand it in the political context to make any sense of it. Mm-hmm. We're striving mightily to kill each other, celebrating the destruction of tanks and the people inside, celebrating the sinking of ships and the people inside, while simultaneously buying materials from each other outside the battlefield. This doesn't make sense unless you think of it as a political construct.
Yeah, and as you're explaining that and answering that question, it almost seems like it comes back down to the quest for power and more maybe greed is a better word. And with, let's say, the absence of that, it seems like there would be far less conflict, right?
I think it's greed for power. Mm-hmm. I think the currency for politicians is power. Mm-hmm. What makes them sleep nights? While I might, I might want to build up my financial portfolio, I think politicians, I think their portfolio, I think the thing that gives them joy is the ability to allocate resources, having power over other people. And I definitely think that if you look at the conflict in the Ukraine or any other conflict I've been aware of in my lifetime, it's been about power. It's been about political power. Mm-hmm.
So, Rick, if we look at, for example, the difference between the available sources for oil and gas in the world versus the ability or availability of, say, enriched uranium or nuclear fuel, does that disproportionately affect countries that rely heavily on nuclear power down the road at some point?
No, it impacts it in the next year. The Russian capabilities, as an example, in processing and reprocessing uranium can be duplicated in other countries. It'll just take 5 or 6 years and the political will to permit it. The Russians aren't using proprietary technology. They're using the fact that an agreement was in place, a wonderful agreement, by the way, between the United States and Russia, where the Russians would receive material aid for downblending their weapons-grade uranium into fuel-grade uranium. Mm-hmm. The consequence of that is that the Russians were encouraged and allowed to dominate the world's processing and reprocessing capacity. That can be dealt with, but it can't be dealt with quickly. With regards to Russian exports of oil and gas, the same situation applies. In the near term, there is no substitute in Northern Europe for Russian oil and gas. I realize the big thinkers of the world believe that Germany ought to substitute solar power for natural gas. The problem is the sun doesn't shine there. And that's unlikely to change in the near term. Investors and politicians need to understand that markets work. And if the natural gas price were to go, as an example, over any substantial period of time to, say, $20 per million British thermal units, we would find a way to get either liquefied natural gas or Azerbaijani gas or Libyan gas or Algerian gas to Northern Europe. It would take some time, and the big thinkers would need to approve things like pipelines, but that would occur. Markets are very messy, but markets always work. And to the extent that there are geopolitical disruptions, a workaround will occur as a response to pricing. But the workaround won't occur in time to forestall political pain.
Well, in that exact vein, as we think about how these political decisions are made that end up coming back to have these negative ramifications. For example, oil and gas was actually getting quite expensive before the actual conflict broke out. Do you think that we get to a point where we see a reversal in some of these ESG policies that as you say, the big thinkers of the world have instituted?
In the long term, yes. In the short term, no. Mm-hmm. The political reality, as an example, in your country, in Canada, is that the political elite, at least the political elite around the Bloc Québécois, the Greens, the Liberals, and the NDP, is anti-fossil fuel. That's ironic for Canada, particularly for Western Canada. And I think in the near term, the fact that the anti-fossil fuel elites are important sources of campaign contributions and are politically aligned with academia and the big thinkers around those political parties means that irrespective of the fact that it's in Canada's economic interest to develop, in particular, their natural gas, that it isn't going to happen in the near term. My country isn't blameless either. We are now trying to make deals with places like Venezuela, which have been historically hostile to us, to feed heavy crude into our Gulf Coast refineries when Canada is ready to send us a million barrels a day through the Keystone Pipeline. There is a dichotomy between the interest of the citizenry in the United States and Canada and the interests of the people who lead the citizenry. That isn't to say that some of the anti-fossil fuel, anti-carbon ideology isn't popular among the voters. What I have noticed among voters, though, is that even the greenest of the voters that I've ever met, when they flip a switch, they want the light to come on. Mm-hmm. I remember in the last uranium bull market, early on in the market, 99, 2000, I was sort of pounding the pulpit in conferences about uranium. And there was always a vociferous minority in the room who didn't object to my thesis in an economic sense. They weren't upset with the fact that uranium hadn't performed for 20 years. Rather, they accused me of being a profiteer on Hiroshima, Nagasaki, Chernobyl, Three Mile Island, and Fukushima. Well, this is pre-Fukushima. Mm-hmm. And I noticed some of the exact same people 5 years later, persistent and harassing for stock tips in the uranium space. Human nature. And I think the circumstance of that is that if we saw markedly higher, which I think we will, fuel costs in Eastern Canada, that the idea that there might be some way to get Western crude and Western natural gas into Quebec might change over 5 years. Certainly, we've seen this in Japan, where, as a consequence of Fukushima, nuclear power was extremely unpopular with Japanese voters until as recently as a year ago. Now, all of the opinion polls in Japan show that the Japanese voters are in favor of restarting the nuclear fleet for two reasons. One, they've come to understand that the only probability that Japan has of meeting the Kyoto Protocol 2050 pledge is nuclear. And the conflict between Russia and the Ukraine has shown the fragility of global energy supply chains. And I think that sort of gradual understanding of consumer self-interest, voter self-interest, means that over the very long term, people act rationally.
Yeah, because the light's not coming on when you hit the switch or being cold suddenly tends to change your mind over time, right?
I suspect that California may face brownouts this year. We've shut down all but one of the nuclear power plants in California. We've obviated any of our access to coal-fired power from the Four Corners. We have prohibited on a statewide basis a lot of oil and gas drilling, but we haven't curtailed the economic or population growth of the state. we make an awful lot about the fact that the state was, at one point in time, 3 months ago, 100% powered from solar power for 2 minutes.
Before what happened?
Yeah, I don't know what happened. The point of it is that even in a place where the sun shines, like California, intermittent power generation isn't sufficient to meet the energy needs of the state. And it wouldn't surprise me, particularly in a year like this, where an awful lot of power is going to be needed to be spent moving water, which the state is also out of, that we are going to run into this circumstance where narrative runs into physics and reality, and where the state, first of all, experiences widespread water shortage, and probably a series of rolling brownouts or blackouts. I think that'll begin to change the political equation.
Yeah, I couldn't think of anything that would be more dramatic to help educate some of those voters on their choices. But Rick, as you're mentioning let's say the Japanese restarts, what other real catalysts do you think that the uranium industry needs to see the price keep appreciating past this kind of $45 level that we've really seen it stuck at, minus a little bit of volatility here, really over the last year?
The only thing that can keep the uranium price over time below 75 US dollars is a global recession or depression. Mm-hmm. People want it to happen immediately. People believe, and I'm guilty of this too, that people believe that if an outcome is inevitable, that it's imminent. Those are very different words. Mm-hmm. Higher uranium prices are absolutely positively baked in the cake. On a global basis, we're using 180 million pounds. And at current prices, we're producing 120 million pounds, meaning that we're consuming more than we're producing to the extent of 60 million pounds a year. Nobody knows what the above ground inventories are, but we do know that the Sprott Physical Uranium Trust has bought 55 million of those surplus pounds. We know, too, that the global total cost of producing uranium, including inefficient producers, and importantly, including prior year write-downs in the cost of capital, is about 60 US dollars per pound. So we know over 5 or 6 years that if the price doesn't go above 60, the lights go out. That's what happens. Mm-hmm. We know, too, that when you use up the overhead, and I don't know when we use up the surplus inventory because I don't know what it is, that the incentive price needed to put new uranium production in place is more like $75 US per pound. We know further that the purchasing power of the US dollar is declining by about 8.5% compounded, which means that the capital costs are increasing by at least 8.5% compounded. So that $75 number is in constant dollars, mm-hmm. not nominal dollars. I think that the near-term catalyst will be Japanese restarts. I think in the 7-year time frame, the 10-year time frame, things like new reactor construction, small modular reactors, stuff like that will matter. But in the very near term, a Japanese restart increases consumption by something like 10 million pounds a year, while at the same time taking a bunch of existing Japanese inventories out of the held for sale category over into the held for fuel category. Mm-hmm. And I think that's extremely important. Will it happen in 3 months or 4 months or 6 months? I don't reckon. Will it happen in a year? Absolutely. The second thing to consider, Tom, in the uranium market is that people pay attention to the spot market because the spot market is reasonably available to them. But transactions take place in the term market. Mm-hmm. And importantly, both Cameco and Kazatomprom, the two largest uranium producers in the world, have said that they won't restart their shut-in capacity until they have been able to contract enough long-term supply into the reactor market that they can operate those assets earning a reasonable return on capital employed for their shareholders. That's extremely important. There's about 35 million pounds in annual production that could be brought back on within 18 months. And this has always been regarded as overhang. But if that supply is contracted for, that's a very different circumstance. And I have reason to believe that a lot of that capacity is in the process of being contracted for as we speak.
So, Rick, as you talked about the spot market and the Sprott physical uranium trust pulling those pounds off the spot market, I recently heard that the New York Stock Exchange listing did not go through. So, do you see that as a real negative, or how do you see that?
Definitely a negative. If you would have asked me at this time last year if we could have raised, I used that incorrectly, my former employer could have raised as much money as we have raised simply with a Toronto Stock Exchange listing, I would have said no. The wonderful thing about the world is it's becoming more transparent, and American family offices and institutions all of a sudden know where Toronto is, which is a wonderful thing. I do believe that had Sprott been able to get a New York Stock Exchange listing, that the liquidity in that instrument would have been substantially greater. There are some institutions that aren't large by American standards, but they're $2 or $3 billion institutions that have U.S. exchange mandates. There's a lot of them. And there are a lot of retail investors in the United States, particularly in the discounters and the online firms that have to have NASDAQ or better. The deepest source of liquidity in the world is the United States. It's about 24% of savings and investment assets worldwide. So the ability to facilitate transactions on the deepest and most liquid securities market in the world would have helped. That notwithstanding, we have a $3 billion and change U.S. market capitalization. The instrument is fairly liquid on Toronto. We get inbound inquiries every day from retail investors and institutional investors. So, I think the product is working and will continue to work. The New York Stock Exchange, I don't know this, I suspect got some pressure from the utilities who liked the spot market the way it was. And two, this was a pioneer product. Which meant that it was a product the likes of which the New York Stock Exchange had never seen before. In our earlier gold, silver, and platinum and palladium products, the units were at a certain level redeemable, meaning that you could surrender your units and receive physical gold, as an example. For fairly obvious reasons, you can't make a uranium product redeemable. We don't want a bunch of folks with drums of yellow cake in their basement. But the fact that the structure of the product was different than other products that the New York Stock Exchange had been able to approve meant that on the basis that we asked them to approve the product, they couldn't do it on a timely basis.
So, Rick, is there anything about, let's say, the conflict or the current geopolitical landscape that has made you change your mind or strategy on any of the asset classes that you're interested in?
Not particularly, because those great big topics are beyond my ability to consider. I mean, one thing that everybody has to consider way far in the back of their mind is if this thing escalates and becomes nuclear, we have deeper considerations than monetary considerations. But I think that what the conflict has done for many people is brought back front and center the notion of the fragility of supply chains. That's certainly happened. I think, too, sadly, one of the things it's done for me is crystallized in my mind that the circumstance that we've lived through for the last 40 years, which have probably been the most benign period in the history of humankind, declining interest rates, increasing globalization, wonderful demographic boom, much more global peace. It looks like that's over. That's unfortunate. You can't take interest rates too far below zero. So, negative interest rates means that the lowering of nominal interest rates probably doesn't occur for any period of time. The idea that inflation is benign, transitory, and under control is obviously a lie. That's too bad. Mm-hmm. The period of globalization, in a good sense, the idea that the Chinese did what they were good at, and we did what we were good at, and that people traded more, and there was specialization of labor, I think was a good thing. It wasn't a good thing if you were a factory worker in Ohio and you were replaced by somebody who made $1.50 an hour. Mm-hmm. But from the point of view of people who bought the stuff that was produced, it was a very, very, very good thing. It is possible, too, that the epoch of peace and cooperation among governments that certainly characterized the 1990s is for a while over. And that's very scary. Not much I can do about it. Mm-hmm. And I only let the macro guide my paradigm. I believe that making money is all about considering macro, but buying micro. I'm interested in investments at the firm level rather than at the global level.
Mm-hmm. Rick, you and I have spoken before about what would have to change for your thesis on, let's say, gold to change dramatically. So considering that we still have, real negative rates, negative real rates, and up to this point, we're still seeing quantitative easing. Has your bullishness on gold changed in any material way?
Increased. It's increased. Listen, I see 5 reasons why gold goes higher. And when I say gold, I mean precious metals. The first is, as you suggest, quantitative easing. 35% of all US dollars in circulation have been created in the last 30 months. Is that to accommodate an economy that's grown by 35% in 30 months? Of course not. When that reason to own gold goes away, I'll consider selling my gold. Debt and deficits. On-balance sheet liabilities in the United States, $30 trillion or $23 trillion net. Off-balance sheet liabilities, net present value of off-balance sheet liabilities, $125 trillion. Congressional Budget Office number, not some cranky, bald libertarian. So the total debt, not including federal, state, and local debt, not including unfunded pension plans, is just shy of $150 trillion. We service that with a budget that's in deficit by $2 trillion a year. In other words, rather than service it, we add to it by $2 trillion a year. When we balance the budget, and when we begin to make a meaningful contribution in paying down the federal debt, I'll sell my gold, which is to say maybe the 12th of never. But the real killer for me is negative real interest rates. If you look at the competition for gold, I would suggest that the most formidable competition for gold has been the U.S. 10-year Treasury, which has outperformed gold substantially for 40 years. But now the U.S. 10-year Treasury pays you 200 basis point nominal yield in a currency where the purchasing power is declining by 850 basis points nominal yield. The U.S. government absolutely, positively promises to reduce your wealth by 6.5% compounded every year for 10 years. Mm-hmm. Jim Grant calls that return-free risk. When we have a positive real interest rate, which is to say, when the U.S. Treasury pays me 150 or 200 basis points real yield above the CPI stated rate of inflation, I'll sell my gold. Mm-hmm. The consequence of those 3 factors, the manifestation of it is in 2 places. One, the market share of gold relative to other asset classes after 40 benign years is minuscule. 0.5% of total savings and investment assets in the United States is in precious metals and precious metals related equity. That's down from a 4-decade mean of between 1.5% and 2%. I believe that quantitative easing, debt and deficits, and negative real interest rates between them will cause the market share of precious metals and precious metals related securities to at least recover to their 4-decade mean. If that happens, demand for precious metals and precious metals related investments will somewhere between triple and quadruple. And it'll happen, sorry to make this long-winded answer, but I've been thinking a lot about this. Mm-hmm. It'll happen because of disintermediation in the long-term bond market. If you are a manager, let's just say for fun, you were a manager of the CPP, and you are responsible for the well-being of Canadian pensioners 20 years from now, 30 years from now, 40 years from now. And for the last 40 years, 60% of your portfolio has been in equity or alts, and 40% of your portfolio has been in bonds. For 40 years, it's been a great place to be because declining interest rates has meant that the capitalized value of the distributions of the bonds you bought have done very well. So you've had security of income at the same time that you've had capital gains. In a period of rising interest rates, that's over. 40% of your portfolio is now invested in instruments that guarantee that you are not able to look after your pensioners 20 years from now, 30 years from now, 40 years ago. Mm-hmm. You have to do something about that in the next 5 years. You absolutely, positively have to do something about that, unless you believe inflation is transitory, which I don't believe anybody believes. So I think there's going to be massive disintermediation in the long bond markets. And I think I'm not trying to say that the bond market's going to blow up or go away, but I think there's going to be huge structural changes in the bond market. And the consequence of that is that I think that some of that money, a little bit of it's going to flow into instruments that have centuries of reputation for maintaining purchasing power, which is to say precious metals. Mm-hmm. When those 5 circumstances change, when the market share of precious metals in the US economy goes above 2, when you have positive real interest rates, when we balance the budget and begin to pay down the debt, and when governments start counterfeiting, I'll sell my gold. I don't anticipate that happening anytime soon.
Yeah, all of those things. Let's say maybe the market share of metals going over 2% might be the first one of those that we see, right?
It wouldn't surprise me if that happened. I mean, listen, I can't imagine what it would be like to be a portfolio manager of a university endowment or a pension fund or a life insurance company right now, understanding that everything that you've done for the last 40 years guarantees the ultimate bankruptcy of your fund. Think about how you need to reorganize what you do, particularly in a market like today, which is plagued by both volatility and illiquidity. I'm delighted that I don't have that job.
So, Rick, something that you and I touched on again before we hit record here today was what makes the metals so attractive, and why people don't really view, in some ways, the sale when these metals go on sale, why that doesn't make them more attractive at that time.
I think I know the answer to that. Notice I said think. Von Mises teaches in Human Action that people's anticipation of the future is set by their experience in the immediate past. We've been through now 4 decades where inflation hasn't been a consideration and life has just gotten better. My first bull market was the bull market of the 1970s. The writing was on the wall for inflation beginning in 1967. 1968, 1969, 1970, 1971 featured high inflation, but nobody cared because their experience with the past 20 years had been fairly benign. Mm-hmm. It wasn't until inflation worked havoc with their paychecks, with their savings, with their lifestyle for 4 years. It wasn't until inflation bit that it went from being an item of interest to an item of fear. We've been through a circumstance now where inflation has been a consideration for about 12 months, but it hasn't bit people. If somebody gets a 3.5% pay increase in a currency that's depreciating by 8.5% a year, it doesn't impact their lifestyle right away. Mm-hmm. If somebody has $100,000 in the bank, which is to say they have some liquidity, the fact that the purchasing power has declined doesn't hit them right away. 4 years from now, when the price of a new car is $75,000, and a car becomes unaffordable to many Americans or Canadians, when the price of shelter continues to go up and it becomes unaffordable, really truly unaffordable to Americans and Canadians, to the point in time where a shopping cart full of groceries is a consideration rather than an annoyance, then I think that the appeal of precious metals and precious metals related assets will become immediately apparent. But I really have noticed that when I go into investment forums around the world and talk about contrarian investments, when I talk about things that have to go up as opposed to things that have gone up, people don't care. People require the validation of the thesis by price action, which is to say somebody doesn't want to buy an asset class until it's already fully or overpriced, because they need the psychological justification to give verification to the narrative. Mercifully, at age 69, I don't need that anymore.
Well, and it takes, obviously, it takes a lot of time to really develop that discipline and that perspective to be able to, as it's been said before, hold your nose to buy some of these asset classes.
Well, I think the last 40 years have spoiled people. People think that their time preferences matter. I know a lot of speculators who have trauma holding stock over a long weekend. And they think the fact that they have a time preference is relevant. It's not. The market doesn't care about your time preference. My experience has been, in order for me to enjoy a real win, I describe a speculative win as a 10-bagger. Most 10-baggers in my career, almost all of them, in fact, all of them that I enjoyed in size, have taken between 5 and 6 years. And in every circumstance that I can remember, at least at one point in time over that 5 to 6 years, the price of the security has fallen by half. So you have to be, first of all, fairly durable. You have to be able to endure the psychological difficulty of seeing a $4 stock become a $2 stock. At the same time, you need to understand that although you might want this wonderful event to happen in calendar 22, neither the stock nor the market cares too much about what you want. You have to assign yourself a narrative that's achievable.
So, Rick, considering the fact that we seem to be looking at a global recession and or depression, and we have many countries starting to ban exports to save more food and energy for use internally, does this provide a landscape where you see more opportunity for massive arbitrage opportunities to develop in some of these countries when demand for these goods grows? Or is the demand destruction side of the equation bigger and more unpredictable and therefore too hard to judge?
I think it depends on the goods that you're talking about. I think you could see real disruption in consumer durables and consumer expendables. I don't think that you'll see ugly disruption over any substantial period of time for basic foodstuffs, basic energy, necessities. When I say any period of time, I could see the market for oil and gas or wheat or corn or rye or any of those things disrupted for 18 months. But what I've learned after 69 years on Earth is that 18 months doesn't matter. 5 years matters a lot because 5 years is predictable. Yeah. History has shown me, and this is a mistake that I've made throughout my life, that luxury goods are extremely durable. There is between 1% and 5% of a population that out-earns the rest of the population. And to them, the psychological well-being that they get from luxury goods means that they will find a way to afford them in almost any circumstance. I'm not a luxury goods investor, but I've learned that luxury goods producers do extraordinarily well during difficult periods of time, which is contra to what I would have believed for most of my life. It's the middle that gets hurt.
So, if we let's say segregate our type of thinking in that way of splitting the luxury goods from, let's say, the essentials for life, when we take that bifurcation thinking and apply it to the commodity markets, where do you see the narrative has, let's say, overrun the reality, and where do you think that opportunity still lies?
I don't know, because I'm not an investor in the broad economy. I don't know how to value tech stocks, as an example. I just don't. I don't know how to understand the net present value of a technology that I can't spell or pronounce. I'm also not a consumer. I don't know how to operate a television set. I'm telling you the truth. I don't know how to dress myself. My wife does it. So the idea that I would understand the impact of narrative on a popular culture, that I could be a consumer goods analyst, is a non-starter. I understand conventional financial services, lending money and getting paid back, allocating capital, and I understand natural resources. So I confine myself personally to subjects where I believe I have a competitive advantage over most other participants in the market. The question that you asked me with regards to the broad economy and society as a large is of interest to me, but I assign absolutely no value to my own opinion. Well,
that seems counterintuitive. If you assign no value to your own opinion, but yet it has taken you to this spot in your life, that seems kind of counterintuitive.
Well, what happens is I concentrate on what I can understand better than other people. Mm-hmm. I think that it is not unlikely that we have a global recession, or maybe even a depression, mm-hmm. in the 5 to 7 year time frame. I don't know that we will, so I take it into consideration. Mm-hmm. In that circumstance, I could see the shares of ExxonMobil declining by 50%. If we don't, I see the shares of ExxonMobil increasing by 300%. So I juxtapose my willingness to accept a 50% decline against my eagerness to accept a 300% gain. I think the probability is that I get the gain, not the decline. But I right-size my investment to accommodate the possibility that I suffer a 50% loss. And that's the closest I can get. I have found that the search for perfection is a form of procrastination. And the consequence of that is that I do the best I can to assess the probabilities with the tools I'm given. Mm-hmm. I stick to investments where I can form an opinion as to value. And then I suffer the consequences or enjoy the benefit.
Rick, exactly in that vein, you've said before that you invest for a range of probabilities. So what are some of the factors that make, let's say, junior projects to you more attractive than others to suit that range of probabilities?
With juniors, the first thing to me is people. I believe in Pareto's law. I believe that there's a group of serially successful people, and then there's everybody else. And I try to hang out with or invest in management teams that have been serially successful. Importantly, I want them to be involved in a task which is suited to their own skill sets. So if, as an example, somebody has been successful because they operated a gold mine in Archean terrain, 2 billion year old rock in French-speaking Quebec, and they've been successful, but the task at hand is exploring rather than operating in tertiary volcanic, 15 million year old rock in Spanish-speaking Peru. I don't consider their success necessarily to be germane to the task at hand. Mm. So I try and allocate capital to people who have been successful in a task that was very, very well related to the task at hand. I believe, because I've learned this, that most exploration efforts, and in fact, most development efforts, end in failure. And so my anticipation in every single circumstance where I put money out, my expectation is that I'll lose a little money as opposed to make some. Mm-hmm. What that means is that the quantum of my successes has to amortize my failures. And I look for circumstances where I could make a lot of money if I'm right. I want a target or a deposit where the minimum in situ recoverable reserve and resource at current commodity prices is sort of $2.5 billion minimum. So, 1.25 million ounces of gold as an example. I want to believe that my target or my deposit will be in the lowest cash cost quartile worldwide. In other words, it'll win the last man standing contest in a depression. Mm-hmm. I also want, at current commodity prices, it to be in the best quartile worldwide in terms of return on capital employed. Which is to say, I want to do something significant. I have zero interest in investing in small mines. Small mines make small money, and you take big risk. And the idea that I would take big risk for small rewards is sort of silly. Mm-hmm. The other thing is that I'm addicted to bad markets. If you want to buy low and sell high, that presupposes that you are able to buy low. Mm-hmm. And you can't buy low in a market where everybody's thesis is validated. That is to say, where you're competing against other people. I'm term sensitive. I would prefer, when I can, to buy juniors by private placement. I would prefer to own fewer names and more of those fewer names. I would prefer to know lots and lots and lots about my investment so that I can maintain an educational advantage relative to my competition. Mm-hmm. In order for me to do that, I need incentive, which is to say I need a warrant. And to the extent that somebody proposes a private placement to me without a warrant, they better give me a coupon. You don't have to give me a warrant if you give me a preferred, if you give me a coupon. But if I don't get coverage for the time value of money, with a participation in the upside that would be generated by the capital I contributed, I have no interest. Mm-hmm. So for the last 3.5 years, capital has been relatively easy for the juniors to obtain. Warrants haven't been on offer. The consequence of that is I've been on strike. This has been, despite my reputation, despite my access to management teams, this has been the slowest period in terms of private placement subscriptions of my career, going all the way back to my early 20s when I was broke. Mm-hmm. I think that's changing now, Tom. I think we have a circumstance where, because the market that we enjoyed 2 years ago didn't follow through, a lot of resources, fair weather friends, have disappeared. A lot of the $50 million hedge funds that were writing checks to anybody just so they could deploy the capital and get their management fees. I think those guys have gone to hedge fund heaven. I think some of the very, very, very aggressive speculators in major metropolitan areas in Canada have been spanked. I think there was a lot of guys had $1.5 million on the market. And they have 500,000 of it left. For me, that's a wonderful circumstance. Let me give you an illustration. Years ago, when I ran a retail brokerage operation in California, we were located in, and I've used this example before, but probably not on your show, probably not for 10 years. We were located on the south side of one of those sort of typical Southern California faux Spanish shopping centers. Mm-hmm. And on the north side of the shopping center, there was a store, a grocery store. And so I used to tell a story of a hypothetical customer that would come into the shopping center. And this was a traditional couple. The wife would go to the store to buy food and stuff for her family, and the husband would come to the stock brokerage to do, shop for financial assets. So one particular time they came in, the wife goes to the store and she sees a brand of tuna fish on sale for $2 a can. And her family likes tuna fish and she's familiar with this brand. And she thinks that $2 is a fair price for tuna fish. And she buys, 10 cans of tuna fish or something. She's relatively comfortable with her purchase, And the husband comes into the stock brokerage and he sees a gold stock that he's heard of before from his newsletters and stuff. And it's selling for $2 a share. And he thinks that's a reasonably attractive price. And so he buys 1,000 shares. And the couple goes home and they're relatively satisfied with their transactions. 2 weeks later, they come back and the wife goes into the store and the same can of tuna fish is marked up from $2 to $4. She's pissed. She gives the store manager a piece of her mind about price gouging, and she substitutes chicken for tuna fish, but she's still angry. The husband, by contrast, comes into the brokerage firm. Nothing has changed with regards to the stock or the tuna. Mm-hmm. It's the same product. The stock is at $4 a share. The husband is elated. The stock's gone from $2 to $4. So he buys another 1,000 shares at $4. Stock is going up. We must have it. He goes home absolutely ecstatic. 2 weeks later, they come back again. Every housewife in Southern California had the same reaction as housewife number one. The store is packed to the rafters with tuna fish, and it's on sale for $1 a can. So the lady buys so much tuna fish that her car is riding low in the trunk. The husband comes and he sees the $2 stock, which became a $4 stock, now at $1. Nothing has changed. And he's disgusted and sells all his stock. If more investors would buy stock the way the lady bought tuna fish, their fortunes would be much, much, much better off. Mm-hmm. I try to buy stock the way she bought tuna fish.
The curse of the recency bias, right?
That's right.
So, Rick, as you're looking at taking some of these positions, how do you think about, really taking a meaningful position, investing enough that makes a material difference to your portfolio?
Well, two things. I don't invest more than I can afford to lose at least half of. Mm-hmm. And I invest knowing that if the circumstances that caused me to invest are no longer true, I will sell aggressively at a loss. So if I buy something for $1 and it goes to 50 cents and it goes there for a reason, I'll take the 50 in preference to taking 20.
Yeah.
Many investors won't do that. They say, well, I'm going to wait till it goes back. Well, why will it go back? So that's an important thing. I have the discipline born of prior year losses that allows me to do that. I think that money is made on the delta between price and value and price and ascribed value, which means I never buy a piece of stock if I don't have a sense of what the liquidation value is, which goes to my downside. I want to be able to quantify my downside. Mm-hmm. And I want to understand the value proposition as to what might create my upside. If I'm hopefully going to write a check next week, a fairly big check for me. And from my point of view, the stock is cheap. It's about 65 Canadian cents. I won't name the issuer. And I'm going to try and write him a pretty big check. They're going to need to raise another $120, $130 million in the next 18 months. And so there's a huge financing overhang over them. And people don't want to give them money as a consequence of that. So I want to give them money now that nobody else wants to. I think that there is a probability that after the final financing is done, depending on market conditions at the time, that 2 years from now, the stock trades at $2 or $2.50. There's also a chance that they won't be able to finance and that the stock trades at 60 cents, or pardon me, 30 cents or 25 cents. Mm-hmm. Top quality group of people, big deposit, decent grade, understand the geology. So I look at the circumstance and I say, what I think is going to happen is that the stock is going to go from, in the 2-year time frame, assuming that the gold price doesn't move, 60 cents to $2. In other words, a solid triple. Mm-hmm. I think if I'm wrong, that it goes to 30 cents. So I juxtapose making $1.20 against losing 30 cents. I think more importantly, that if I'm right, 5 years from now, that this stock goes to $5. So really in my own mind, I'm looking at a 25 or 30% probability that my 60 cents becomes $5. Mm-hmm. Except for my 60 cents will, if I write the check, include a $1.20 5-year warrant. If that happens, my gain is 60 cents to $5, which is to say $4.40, plus $5 minus $1.60. So what's that, $3.40? Mm-hmm. All of a sudden, I'm looking at $7.50 on 60 cents, mm-hmm. as opposed to a 30-cent downside. Making a series of disaggregated bets, say 10 disaggregated bets, where the probability is that you're going to lose a little, but the possibility is that you're going to make a lot, is what speculation is all about for me.
And again, you have that time frame really, let's say, forefront in your mind for what that the possibility is that takes that project to play out, right?
People who are speculating who don't have a 5-year time frame aren't speculating, they're gambling, because that's how long it takes. You don't need one piece of good news. You need 3 or 4 pieces of good news. And one piece of good news builds on the last one. In order for compounding to take effect, in other words, in order for a stock at 60 cents to be worth $5 or $6, you need several good circumstances. And it takes 5 years for that to occur. I understand perfectly that people wish that wasn't so, but their wishes are irrelevant.
All right, Rick. Well, I really, I want to be respectful of your time. You and I have been speaking for quite a while here now. Why don't you tell our listeners some of the educational and excellent conferences and events that you have coming up as part of Rural Investment Media?
Now, 3 things I want to talk about. First of all, many of your listeners will remember the Vancouver Natural Resources Investment Symposiums that we've put on for 27 years. Obviously, COVID got in the way of that, and we went virtual for the last 2 years. We're going back live now, but I didn't have the courage to do it in Canada because of political and public health challenges in 2 countries. So we're doing the conference this year in Boca Raton, Florida. We'll send you a link that you can append to this interview. It's between July 26th and July 29th. All modesty aside, which is easy for me to do, this will be the finest natural resource conference available to investors this year. The finest because we'll have wonderful big picture thinkers, the gurus who can put the questions that you've asked me today into context. Jim Rickards, Daniela DiMartino Booth, Nomi Prinz, Grant Williams, Bill Bonner, Doug Casey. We'll have also the best analysts and gurus telling you how to superimpose this macro on investors. More importantly than that, we'll have a crew that we've always had, the living legends, which are natural resource operators who have built multi-billion-dollar companies from standing starts, tell you how they did it and tell you how the lessons that they learned doing it made them better investors and can make you a better investor. Finally, we'll have 60 exhibitors there, which are curated. In most conferences, the qualification to be an exhibitor is a pulse and a check that cashes in reverse order of importance. At our conference, every single public company exhibitor must be owned in an account that we manage. Sadly, that doesn't, because I own it, doesn't guarantee it goes up in price, but it does guarantee that I vetted the exhibitor well enough that I'm risking my own capital on the exhibitor. Like any education product that Rural Investment Media has ever put on, anybody who pays the tuition charge and doesn't think that they got their money's worth can get a full refund simply by asking. So I think that's a mark of confidence, and I think people need to take that into account. The second thing that I want to tell your listeners about that I'm extremely excited about is that I'm celebrating retirement by starting a new bank. Many of your readers will remember EverBank, which was our last adventure in banking, online banking, where I backed a wonderful team beginning in 1999. We built the bank from a standing start to $28 billion in AUM, simply by being a good bank, by offering good customer service, by blocking and tackling. Any of your listeners who are unsatisfied with their current banking relationships and what would like to explore doing business with a real bank, it's going to be called Battle Bank because we truly will battle for your business, should ask me for information about it. You ask me for information about it at ruleinvestmentmedia.com. And to give you an incentive, any of your listeners who go to ruleinvestmentmedia.com can enter their natural resource stocks. Please no crypto, please no tech stocks, please no pot stocks. I'll rank your natural resource stocks 1 to 10, 1 being best, 10 being worst, if I know them. If I have comments on them, I'll append the comments. And if you care about my bank, in the question and comment section, write bank. Further, because I'm no longer a broker, I can tell you about the private placements I'm doing because I'm not soliciting. I don't get paid. So if you care about the private placements I'm doing, I'll distribute that information to you. All you have to do in the question and comment section is write in placements, and I will send you a note every time I do a placement where I'm allowed. No guarantee that you'll get in the placement, but you'll know what I'm doing with my own money and why. So once again, ruleinvestmentmedia.com. Fantastic conference. I want to see you there. If you aren't happy with your current bank, I'd love it if you wrote bank in the comment section. I'm happy to rank your natural resource stocks. And if you are an accredited investor and want to see my own deal flow in private placements, I'll send it to you for free. Write down placements.
Rick, I want to thank you for being so generous with all of your offers, with your time, and especially with your knowledge. I know I have learned tons from you over the years, and I really appreciate you sharing all of that with us today.
I really enjoyed the conversation today. I like talking about investments, but I also like talking about the philosophy behind investments. So I've been particularly amused by this discussion. Thank you.
Me as well, Rick. It's always a pleasure to speak with you. And like I said, every time I personally am looking forward, or I see your name on the calendar, I'm excited, and everybody around me always mirrors that. Definitely. Rick, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.